we're going to carry on and we'll try and make some adjustments as we go. Okay, so there's three main ingredients to make money in the stock market that you need. The first one is earnings. I'll touch on that for a second. There's been a big recovery in corporate earnings over the past 5 years. There's a reason for that is in 2008, 2007, when the world kind of started to roll over, every corporation was very scared, as you and I both were, watching the world collapse. And corporations, they cut costs, they closed factories, they laid off employees, and they basically hunkered down to get through the recession. And then when the world actually did not end and the Fed decided to stimulate the economy again, these companies found that their profit margins started to expand dramatically. So from a corporate earnings point of view, it's been really, really quite phenomenal in terms of corporate growth and profit margin growth. It has not been phenomenal for those of you that might be looking for a job because none of these corporations were really big on hiring back the people they fired. But from a corporate point of view, all is pretty good. From an interest rate point of view, if you've been reading the newspaper, you don't need to go into that too much. But the Fed has driven down interest rates to historically low levels. Money is free, easy, and accessible. Corporations have still been a little bit reluctant to utilize that free money, but that may change as the economy gains traction. And from a interest rate comparative situation, you all know what's happened to your bond funds and your GICs. If you're making 1 or 1.5% on an income investment, then a stock market dividend at 3 or 4% that's taxed better starts to look pretty good. The other thing is funds flow, and this is really quite important, both from a confidence level and a pure asset allocation level. So on the asset allocation side, investors worldwide are shifting from bonds to stocks, and so there's this massive flow from one asset to the other, which is driving the stock market. The bond market has been really quite strong for about 30 years now at the expense of the stock market, so maybe that shift will continue and go forward. Also from a funds flow, money on the sidelines that is now a little bit more confident. The world, as I mentioned, did not end. Investors are confident, they're seeing the rising market, and it basically, confidence begets more confidence. They're willing to spend a little bit of money, invest, take a little bit of risk, and we're back in sort of an equity type of positive scenario. So if I shift back to earnings, what are corporations doing? I just threw a couple out here. Vigilon makes high definition cameras for all sorts of industries. In their last quarter, 298% earnings growth. It's just absolutely fabulous numbers. Companies left, right, and center are reporting very, very strong earnings. CP Rail reported very, very strong earnings. Badger Daylighting just knocked it out of the park in terms of earnings. So the earnings picture is absolutely rock solid. I'm just moving some slides forward because we're on two different computers. So CP Rail is interesting because it's of course a generalized economic industry. They're shipping goods across the country and they have a 42% profit growth. There's really no problem in terms of average corporate earnings. Sure, there's one or two companies that have messed up, but on average, corporate earnings have been really quite spectacular. So on interest rates, the big question that everybody has in their mind is what's the Fed going to do? The Fed has been spending $86 billion a month buying back debt in the market, trying to support the economy, trying to keep low interest rates, the short-term interest rates low, trying to stimulate investment, trying to get the banks to lend money and trying to convince people that they're going to support the economy until the economy gets fixed. So now everyone's all concerned about what happens when the Fed stops that stimulus and starts tapering back their bond purchases. I'll talk about that a little bit further, but the Fed also looks at inflation, and right now there's really no inflation really to speak of. The Fed is far too worried right now about deflation, and so from a tapering point of view, it's very unlikely that they would be aggressive if they actually started to curtail their bond purchases. From a debt point of view, this is a whole one-week seminar we could do on how inflation is better for the U.S. economy than deflation, and I fully believe that they will err on the side of inflation, so you have to sort of get ready for inflation down the road. But in the short term, it's just not there. The Fed's going to continue to stimulate the economy until it gets fixed. From a funds flow point of view, we talked about the multi-year shift from bonds into equities. That will take time. It will not perhaps go as fast as some people expect, but it's a big, big situation where suddenly investors are looking for growth. They do not really want a 1% bond fund. They do not want a 2% GIC. They want to look for some growth again as the economy gains traction. And I just keep referring back to the economy because that's really such an important factor. The economy is improving in North America. It is improving worldwide. It is not fixed. It is not great, but the worst is over. And I'm always of the view that if the worst is over, then by default, it needs to get better. And I think that's what's happening right now. So in this environment, what you really want to own is dividend stocks. Dividend stocks are paying you back some of their profit, and it's a situation where, as we mentioned earlier, the profit growth is high. Profits are very good at corporations. I didn't talk about this, but balance sheets of corporations are very, very strong. Once again, going back to 2008, when companies cut debt and sold assets and hunkered down, they're now sitting on tons and tons of cash. They don't have a debt problem, and they suddenly realize that their earnings are exploding. So guess what? It's time to reward the shareholders and give back some of that money to their long-suffering shareholders, and that's what you're seeing right now in terms of corporate dividends are increasing at quite a dramatic rate, actually, and they're absolutely fabulous in this environment. You get paid. Dividend stocks tend to be less volatile. Dividend stocks tend to increase their dividends, which you don't get in a bond, of course, and they've been the flavor of the day for a while, and I continue to think that they would be the flavor of the day, for a couple of more years at least. The average bond fund is down 3% this year, and a lot of people are starting to worry about, bonds are supposed to be safe. Everyone says, oh, I want a nice safe bond fund. There's many bond investors that do not even realize that bond funds can go down, and they might want to shift some of that money into something else that is a little bit more attractive. What's more attractive? Well, you could lose 3% in a bond fund, or you could make 25% in the S&P 500 just with the general market without even having to pick a stock. And of course, if you overlay some of the incremental dividends that you could get from stocks, it starts to look pretty attractive. And maybe a bond investor takes 10% of their money, puts it in stocks. But because the bond fund or the bond market is so much bigger than the stock market right now, that could be quite significant even with a very marginal increase in equity buying. TSX is really lagging behind the rest of the world really because of the commodity exposure, but it's starting to pick up a little bit. We're starting to see some pretty good moves in some of the larger companies, and that might improve over the next 6 to 9 months. So I used to be a portfolio manager, and if it was November 16th and my fund was not doing very well and I had a 30% cash position, what would happen would be my boss would come by and say, why are you holding cash? The market is surging. You are an idiot. Spend some cash. And this is what's happening around the world. A lot of people were still worried about what's going to happen in the market. As I mentioned, there's always someone smart who thinks the world's going to end and the market's going to go down. So a lot of investors, fund managers, asset allocations, companies, pension funds were holding too much cash. Now they see the market's up 25%, they've underperformed, they need to spend some of that cash. So you could get a pretty good couple of months in terms of a rally, in terms of if that money comes back into the market. Expectations are all wrong for most investors. As we mentioned, bond investors are not used to losing money. They don't like it, they're not used to it, they get worried about it, they wonder how long it can last, how much it can go down. If rates go up more, what's going to happen to their bond fund? They're kind of confused, they're kind of worried, they're kind of scared. Stock investors, on the other hand, they can't even remember what a bull market looks like. It's been 12 or 13 really rough years in the market, and the average return on an equity mutual fund has been very, very, very low. And investors don't know that markets can go up 5, 6, 7 years in a row if things are good. They just don't know. They're not experienced with that because of the short-term history. And what that means is a lot of investors will sell too early if things are improving. They'll take their 15% off the table, say thanks very much, but they might leave 3 or 4 years of growth behind if we're actually in a bull market. So valuations, I like to split out the S&P valuation into the growth index and the value index. And so on this chart, we're just showing the PE ratio on the growth index is 18.7, pays you a little bit of a dividend, and the growth index is up 25%. And this is S&P splits growth companies and value companies under certain criteria. The value, if we could go back one slide there, the value index, meanwhile, it's got a PE ratio of 15 times. A dividend is there a little bit higher, and it's up about the same amount as the growth index. So I'll just stop there for a second. So you're paying a little bit more for growth, and you're paying a little bit more in terms of a lower yield. So you get a slightly lower yield, and you're paying a little bit more. But here comes sort of the big decision that investors have to make. Value stocks have been very, very good for a period of time. Certainly after 2008, when investors got scared, all they wanted was safety. They wanted safety, liquidity. They didn't want to lose any money, so they started to pay up for value stocks. They wanted dividends, they wanted yield, they wanted safety. Now, if you're getting an economy that's shifting into growth mode, you're getting an equity market that's a little bit more confident, you might actually want to have some growth in the portfolio. The key point here is growth right now is only marginally expensive compared to value. So it's 3 multiple points on a PE basis for much, much faster growing companies. So if I look at the averages here, you can get an average value stock in the S&P for 15 times earnings. Or you can get a fabulous, fabulous fast-growing company in the S&P at 18 times earnings. So if we shifted it back to one of those Canadian companies, Avigilon, at 298% earnings growth, it's not bad if you're only paying a slightly higher premium versus a nice, safe, boring value stock. And so I think that is sort of an indicator that maybe growth stocks are going to start to do a little bit better. Doesn't mean that value stocks are bad at all. I think if the market goes up, they would both go up. But I think as investors search for growth, the growth is out there. And frankly, I just think that growth is worth a little bit more than 3 more multiple points if somebody's growing at 40 or 50 or 60 or 300%. I just think it's worth more. So I'm going to just throw a little quiz at you. Suppose you have a nice little company, stock symbol XYZ. It's XYZ. I'm Canadian. Sorry about that. It's 20 times earnings. It's got good management. It's increased its dividend 10 times in 2 years. Its yield is 2%. It's got great growth potential, a good balance sheet. It really, really looks good. Would you buy it? I think if I threw that chart out at most investors, they would say, wow, that doesn't look too bad at all. 10 dividend increases in 2 years. I love that. Let's buy some of that. Now we'll throw the next chart at you. So that stock is real. It's called Auto Canada. 5i Research started covering that stock at $6 and a couple of years ago, and now it's, I think, 42. So it's gone up 202% in the past year. So now you're saying, okay, well, now I don't want to buy it. It's already doubled, tripled. Look at how much it's up. I'm not going to buy it. But is the company different? Is it still a good company? Is it still growing fast? They increased their dividend about a week and a half ago. Nothing has changed as far as the corporate outlook. Nothing has changed as far as the economic outlook. But the price has changed. So on a company like that in specifics, you have to say, okay, well, what's the valuation? What's the valuation difference? Well, it's quite interesting because 2 years ago when the stock was at $6, the valuation on the company was about 14 or 15 times earnings. Now it's about 20 times earnings. So you have had an increase in valuation, but it's also a much bigger company that's getting more attention. And it's also, their growth rate has been very consistent. So now you've got a bigger company that has consistently outperformed for 2 years that should be worth more than a smaller company that hasn't yet proven itself. But at 20 times earnings for 10 dividend increases in 2 years, we still think from just an individual corporate point of view, it's not a problem. And these type of examples are all over the map. Companies have done so well because they've bounced so hard from the recession, but you need to get behind the stock price and you need to look at the actual valuation, the actual earnings, and the actual fundamentals of the company. Ignore the stock price. Where it's been completely doesn't matter. You got to figure out what it's doing and where it might go from here. Okay, so we talked about cost cutting. That's been driving growth. And now if you want to put your optimistic hat on, what happens when your revenue picks up? So companies have been making lots of money cutting costs, and suddenly the economy turns, investors are, or investment reoccurs in the economy, and people are happy again, and they start buying products and they start ordering new things. And so your revenue picks up, and the leverage to your earnings, because you've driven down costs so much, is just phenomenal. So if we go to the next slide. What's that? Oh, we have a question. Oh, it says, can I see Peter on the screen? We might do that next time, but for this time, we just wanted to make sure it went well, so we didn't turn on the webcam. So Microsoft, I chose Microsoft as an example for revenue growth because Microsoft, everyone believes Microsoft is a complete dinosaur. Nobody wants their products. Apple's cooler, Google is way cooler, and Microsoft is just one of those old companies for old people that you really don't need to care about. But meanwhile, Microsoft reports 13% revenue growth in the last quarter. They've sort of accelerated on the revenue side. And of course, their profits are going up because being a high margin software company, they make a lot of money. And a ginormous company like Microsoft can report 13% revenue. How does that bode for the outlook and the fortunes of the other smaller companies that are much smaller that can triple or double their revenue? And of course, Microsoft, the dinosaur that nobody wants, is up 42% this year. And I think it pays a 3% dividend as well, just as a kind of added bonus for you. So we're seeing revenue growth across the board starting to pick up, and the earnings leverage on that, of course, is amazing. Eventually, somebody will actually get a job. The jobless numbers may improve a little bit because these companies will start making so much money, and as confidence returns, they might actually go hire people. But right now, they're just happy to roll in those profits. So a few days ago, the nominee for the Fed chairmanship, Janet Yellen, she comes out and says the jobless rate is too high and inflation is too low. If you can read between the lines in terms of what the Fed likes to say, basically that means they're not going to taper when people think they're going to taper. They're going to keep stimulating the economy. They're going to drive the jobless rate lower, and they're going to drive inflation higher. It's really their goal in life is to get inflation back on board so they can pay back all of their creditors with lower valued dollars. And again, that's a whole other topic for discussion, but she's basically told you right there 3 days ago not to worry too much about the short term. More on interest rates. Everyone's all concerned about interest rates and if they actually do rise. But unless you're a company with a lot of debt, or you're in the real estate industry, or you're trying to borrow money to buy a company, you might not be affected at all. A lot of the companies that we like to look at our companies are debt-free. They have cash flow. They have too much cash in the bank, and a higher interest rate scenario is really not going to kill them. And even if rates do rise, I don't think we're talking 8 or 9% down the road. You might go from 1% to 2% to 3%. As I mentioned, the earnings leverage at these companies with a return to regular business operations is so high, a 1% change in interest rates is really not going to affect them at all. It affects perception, and it gives the media a lot to talk about. And if you're looking for a house, sure, you're going to pay more on your mortgage, but from a corporate point of view, companies are very used to paying interest, and they've been paying very low interest rates right now, and even if rates go up, they'll still pay historically very low interest rates. So all this worry about interest rates is really a bit overstated, I believe. Just as a repeat, this is another Fed quote, basically saying they're not going to act until the economy is much stronger. We're not in a situation where the economy can actually afford a withdrawal of stimulus at this point. We don't have enough traction. Things are better, but they're not great, and the confidence is not quite there for companies to go out and expand, spend money, and hire people. And so that may take another year, but basically it'll be status quo for a long period, a short period of time. Call it 9 to 12 months before we know. And of course, everything can change based on what the economy does. But if you look at it from a sort of a big picture point of view, if things change too fast, it means the economy is better than expected. And for most companies, having a better than expected economy is really not a bad thing at all. It's not bad for profits. It's not bad for dividends. So it's actually a really good thing if the economy turns. So once again, all the worry about stimulus is misguided, I think. The Fed likes to talk about things, but they don't like to do a lot of things. So we actually think that the Fed will keep talking about withdrawing stimulus until everybody's bored of it. I don't know about you, but I'm bored of hearing about it already. So they'll talk about it for another year or so, and then they might start tapering. They'll do it very slowly and very gradually, and people will just have already priced it into valuations. And hopefully, knock on wood, the economy and the market will just kind of take it in stride. Everyone knows it's going to happen at some point. Eventually it will. But at the time it happens, corporate profits should be good, jobless rates, jobs will be better, and the economy will be better. So we should be able to handle it. And I think, again, there's a lot of people digging a hole in the sand to hide in when it happens, but longer term, it's not going to change too much, I don't think. So if you are worried about interest rates, we promised a couple of strategies. We'll go through these fairly quickly. Having a bond or GIC ladder is fairly easy to set up. The simplest strategy is to have 5 bonds. One's got a 1-year maturity, one's got a 2-year, one's got a 3-year, one's got a 4, one's got a 5. Then you just sit back and relax, and you don't even care what happens to interest rates. Every year, you roll over the maturing bond, you buy another 5-year bond, and you get back onto your couch and relax. It's very easy to do. If you buy government bonds, there's no market risk, there's no maturity risk, and now you've just eliminated most of your interest rate risk. If you hold them to maturity, you really can't go wrong with that strategy. The other strategy we would recommend is to buy high growth companies. As we mentioned before, companies are growing their earnings rapidly, but their stock prices are not necessarily rising as fast as their earnings. If interest rates change, then alternative vehicles, bonds, etc., might not be as attractive, and people might want to actually own something that's going to grow over time. And it's another good thing to go into, again, if you're worried about interest rates. Cyclicals are great if interest rates rise. Some of the metal companies, of course, haven't done anything for so long, but they will if the economy gets fixed and interest rates start to move up. Insurance companies are great for a higher interest rate scenario for 2 reasons. Their bond portfolios make more as rates go up. They continually reinvest at higher rates. Their premiums are always coming in, so they get more money from their premiums as rates move up. But also, of course, their claims don't change if rates rise. So their claims and their losses on insurance claims are the same, but they make more money on their investments, and so they do pretty well. So we just threw up the next slide, I think, is Sun Life, if my slide shows up. Oh, it's not there, but we'll talk about this. Sun Life is one of those, it's our favorite insurance company right now. The stock's done very, very well. It pays a 3% dividend, or I'm just guessing because my slide's not on my screen, 3.9% dividend. And it's one of those names where earnings are starting to increase, but it also does well in a higher interest rate scenario. So it's not a bad one to own in your portfolio. We've always been really negative on Manulife's, but even Manulife's starting to look better with a recovering market. Capital markets are changing, and their whole problem in terms of financial solvency has gone away, and they're starting to make some good money again. No. Okay, just give us 1 second here. Okay, so talking about cyclicals a little bit, the ATS is a great little company that's going to benefit from the shift of corporate spending. So as corporations become more confident, they start spending a little bit of money. ATS is an automation company that tries to make companies more efficient, more productive, and that spending cycle is going to, we think, be really quite important over the next few years. Corporations, when they become more confident, they're not going to go out and hire people right away. They're going to try and improve their efficiencies, their manufacturing process. They're going to try and make more money as they go along. And ATS and companies like that can help companies automate will be quite interesting if that spending cycle continues. So I'm just changing computers because I've got the slide problem going on. Dividend growth is absolutely key in this environment. Not only do you get a nice dividend that increases over time, but you also get a nice capital gain as other investors are attracted to a rising income stream. So if growth is important and investors still like dividends, then obviously a company that can grow their dividends at a fast rate is very attractive to most investors. There's been a lot of studies that have actually shown that dividend growing companies earn about 2% more on average over the long term than companies that don't pay dividends. So if you're a MoneySaver reader, this is nothing new to you, but I just want to mention it because it's a great strategy to go to right now, because you get a little bit of security, a little bit of safety, but you also get that growth potential as well, and so you can do, your portfolio can do remarkably well if you pick the right stocks. There's no guarantees in the stock market, but the closest I can get to give you a guarantee right now is that banks are going to raise their dividends, probably within 3 months. The historical dividend ratio on banks is really quite low, and across the board, give or take 1 or 2, I think you're all going to see bank increasing their dividends probably in mid-December. And they may be fairly dramatic, a little bit more than average in the past, because these banks, again, on average, are making tons of money and their payout ratios are very, very low. So Chesswood, we just threw up a couple of names here. They've raised their dividend twice this year alone. It's a leasing company doing very well. They're benefiting from low rates, of course, but they're paying back shareholders. And if you like stocks that go up, whenever a company raises its dividends, its stock tends to do pretty well. I think Chesswood is up 73% this year. Alaris Royalty, we just threw that up because they've raised their dividend 3 times this year. It's a royalty company. They've got a portfolio of investments, and I think that stock's up 55% this year. But if you look at their valuations, because they're growing, their valuations haven't actually changed that much, even though their stock price has done very, very well. So focus on that, and focus on dividends, and focus on looking at a changing environment, because I think that's what we're going to have over the next 6 to 9 months or maybe a year. So I love this chart basically because we talk to a lot of investors at 5i Research and Canadian MoneySaver, and a lot of them are still investing. They still have more money at the end of the month than they have expenses. They might have $300, $400, $500 each month left over. They have a portfolio, they have dividend income, and they have money to invest. And so I always like to turn it around to them and say, if you're an investor and you're putting money into the market, why would you actually want the market to go up? That makes no sense at all. Every time the market goes down, if you're investing for the long term, that is great for you if you're putting money in. If you're not spending your capital, you're not taking money out, you're not selling everything to buy a house, you want the market to go down. And everyone sort of, whenever I say that, they just kind of, they pause for a minute and they say, like, what are you talking about? But it's true. If you're investing money, you don't want the market up. And so if you consider that, then you worry less about the market the next time it goes down. Oh, okay, we're going to pause for a little break and fix our slide problems. So give us about a minute on this, and keep in mind this is our first ever one, so we apologize for that. Okay, looks like we're back. Apologize for that. We can only see what's happening at our side and not on your side. My computer's fixed. So as mentioned, a change in perception of what the market's doing can be very liberating. If you suddenly don't care so much if the market's going down, then you're less likely to panic, you're less likely to trade, you're less likely to pay taxes, and you're less likely to pay commissions, and your portfolio will be just far, far better off. Of course, the opposite's true if you're taking money out, but that's a whole different strategy. Okay, I love this chart. This is a chart that shows you the emotions of a stock decision or a stock market scenario. So if you, again, if somebody's on an iPhone or something like that, I'll just walk you through some of the comments here. So when the market is at a bottom of, say, 2008, March 2009, when the world was indeed ending, no one could really believe what was going on. They couldn't believe how bad it was. Things start to get a little bit better. They get some hope. Things continue to be better. They get some optimism. Things get much, much better. They believe in the economy. They believe in the market. Things are great. They have the thrill of making lots of money. They're really happy. They start spending money. Then they get the euphoric emotion of the dot-com scenario where everybody makes money all the time on pretty much anything. I call it the pigs can fly phenomena, where it doesn't matter what a company does, it still goes up. And then it rolls over, and I won't go through the rest of them, but you get a situation where emotions play such a factor in stocks and the economy that it's really quite. I love the chart. The other side, on the other side, is the short chart. If you're betting against the market, of course, the emotions work the exact opposite way. So on this chart, I would say we are somewhere between hope and optimism. So if you look at, what might happen down the road, I don't think we're very far along in terms of economic stock market recovery. The people we talk to, the investors we talk to, are still looking in the rearview mirror. They're still scared about what happened and how much money they lost in 2008, 2009. They know things are better, but they're certainly not believing things are going to be better for long, and they're certainly a long, 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 long way away from having a thrill of the stock market or the euphoria of the stock market. So I think we're good for a period of time. Again, we don't try and predict the stock market, but everything we see from a corporate standpoint and from an economic standpoint is better. Not great, just better than it was. So I think there is a little bit of reason for hope and a little bit of reason for optimism. It's certainly not a reason to be fearful at this point in time, but it's also, we're so far away from being truly optimistic and euphoric and having the thrill of everything going up for 5 years. We a long, long way away, and that keeps valuations in check. So we're almost done, and then we'll open it up for questions. I don't think I mentioned we are going to post this on YouTube, so all the slides will be up on YouTube, and we'll put that on our website for the links, and in our next email we'll add the link as well. So from the strategy point of view, being in the business for 30 years, one thing I would like to recommend you do is just ignore target prices, recommendations, and estimates for earnings for companies. That again could be a whole seminar, but the analysts are very conservative. Target prices are designed to make you trade. Recommendations are designed to make you fearful. If someone puts you should sell a stock, then what do you think you're going to do? You're certainly going to worry about what's wrong with that company. But I've just learned to ignore all that and focus on the fundamentals. So the fundamentals that I think you should focus on instead are what the company's doing, what the economies are doing, what the yields are you can get elsewhere. If a bond fund is paying you 9% and it's guaranteed, that's pretty good. The stock market's not going to like that, but we're nowhere near that right now. Cash flow at companies. Is it sustainable? Is it growing? What is the company going to do with that cash flow? How's your dividend? Is the company growing their dividend? There's companies out there that have never grown their dividend. Maybe they're not the best companies to own. Dividend sustainability. We have had a few companies cut dividends over the past year or two. Generally, the first cut is not the last, so it's one thing to watch out for. Just make sure that the company that's paying you money can pay you the same amount of money, but preferably more next year. Invest at regular intervals. A lot of people have asked us, should I put all my money in at one point? I'll just touch on that for a second. It's actually, from a academic point of view, they've actually proven that it's better to put a lump sum in. But from a personal point of view and a confidence point of view, just invest regularly. Again, then you don't care if the market goes down, and you'll take advantage of volatility, and you're more likely to invest for the long term, which is far more important than trying to time any particular purchase. Don't chase yield. We've a company up there called Data Group had a very, very high yield about 2 years ago. I think it was 20%. They cut their dividend, the stock went down, the yield went to 15%. They cut their dividend, the stock went down, and every single week we had people ask us about whether they should buy that stock. Well, now they've cut their dividend completely, and we're not really too sure if that company's going to make it. They've got a lot of debt, and suddenly that 20% yield that somebody bought that stock for 2 years ago might turn into a 100% loss on their capital. So just don't do it. It's not wise. If there's anything that's got a higher yield, there's a definite reason for it. You can give up 1% pretty easily, because if that's a good company that's got a lower yield, you're going to make that 1% back so many times over on your capital as that stock goes up. The 1% or the 2% extra yield that you might get from a risky company is just simply not worth it. Don't gamble. Surprising how I have to keep telling people that. They buy things they don't understand. They buy companies they don't know, and they buy companies that are risky just because they've heard about it on TV or in an investment newsletter or something like that. Don't chase fads. Again, it's common sense, but I like to throw it in there. There's a few fads going on there right now. Everyone talks about 3D printing, which I think is going to be a great industry. but I can't tell you which company is going to be around to make all the money from it. And there's about 100 companies that are trying to get into that industry. So it's like the auto industry of the 1900s. If you can tell me which one's going to be Ford, or in 1990, if you can tell me which company is going to rule the internet, then yeah, that's a great company, but you got to be careful with all the other companies. Dividend reinvestment plans, again, if you're money savers, you don't need to go into that, but one of the world's greatest inventions for investors, to reinvest your money, often at a discount, get it out of the market, or get it out of your hands right away, and you just have the benefits of compounding for years and years and years, and you really can't go wrong. And diversification. There's really no way to protect against big problems, or a lot of people say, how do I protect against a fraud at one of my companies? Diversification is really the only way that really can cover all your bases. In 2008, it was a little iffy that diversification actually helped because everything went down, but in the recovery, it was a very good strategy. So I think it's obviously quite still important. And do your homework. Back to the gambling part of you. Don't buy something you don't know, and don't buy something that you haven't investigated fully. This is your money. Why would you throw it away? And balance. Balance out your portfolio. A lot of people, again, ask us what's the correct weighting of a stock, especially as the stock goes up. And we would just basically say the correct weighting is the weighting at which you're comfortable with. If you can't sleep at night because you've got a 12% position in some crazy gold mine, it's too high. But if you know the company very well and you're confident and they've performed forever, then maybe it's not too high. It's really a personal situation, but you do need to balance out your portfolio, and don't make a bet on one particular asset class, and don't make a bet on one particular company. So just carrying up in a couple of more slides, sometimes your stocks will go down, and sometimes your stocks will go down the second you buy them. And I like to throw that other line in there, if your slides are working out in the internet world, does that mean your company's bad? No, it means that stock went down one day and it's not a big deal. If you've done your homework, you don't need to sweat it at all. At 5 Hour Research, we take investment questions, and every day we get about 50 questions about why is my stock down 2%. And you know what? We don't know. We don't know why it's down 2%, and frankly, you shouldn't care. If there's a reason for it and it's down 10, that's different, but stocks go up and down. Just don't sweat the small stuff. Focus that energy and attention on finding a good company or finding a reason to buy more of the company you liked yesterday. Ask yourself why you're selling. Back to Auto Canada. Are you selling it because it's up? Or are you selling it because you've got a profit? Or are you selling it because you feel good? Or are you selling it for another reason? Please do not sell because it is up. I think that's just not a very valid reason to sell, because there's somebody buying that stock from you, and they have a completely different point of view than you do. They think that stock's going to go much higher, and so you have to ask yourself, what do they know that you don't? I can tell you one thing, and it's pretty easy because it's just the way the market works. Every single stock I've ever owned that has done well has been bought by someone who thought it was a lousy company and wanted to sell it. So if you know the company, don't get shaken out of it. Find out why someone's buying it. Maybe you don't want to sell it anymore. It's something you need to think about. And then my almost final slide. It's your money. I was in the investment industry for a long time. I'm not particularly proud of it anymore. It was fine while I was there, but the whole industry is designed to take a little piece of your money off of you every time. And so this is where you have to stop trading, stop paying high fees, stop paying taxes, stop buying closed-end funds, basically stop giving them your money. This is your money. Don't give it away. A couple of stock ideas. We'll go quickly. Boyd Group is an auto collision and glass repair company. They've made lots of acquisitions. They reported their earnings last week, which were spectacular. Stock's up about 70% this year, but their record of dividends is quite impressive. Badger Daylighting is an oil and gas utility company that the best way to describe it is they have giant vacuum trucks which dig holes in the earth for oil and gas companies and utility companies that are laying pipelines and things like that. In Kitchener, we've got a road that's they're putting a pipeline in, and there's like 17 Badger trucks that I have to pass every day on the way to various places, and they dig holes better. This is pretty simple, but that stock's up more than 100% over the past year. Earnings are 44% year over year, and just a fabulous company. Somebody tried to take it over a few years ago at $22, and the stock's now 81. So maybe they should have tried a little harder at 22. Cineplex, if you go to the movies, you know Cineplex, great record of dividend increases. They made money, they made more money each year of the recession. Bank of Nova Scotia is our favorite bank right now. They will eventually raise their dividend. I can't guarantee that because there's no guarantees, but they will do it. Magna's growing much faster than the rest of the auto industry. The stock's done very, very well, but they're actually earning twice as much money or growing twice as fast as everybody else in the business. So it's pretty good, except for maybe Linamar, which is another great auto company as well. And McDonald Detweiler did a very big acquisition in the U.S. a year or so ago called Laurel, and it got them access to the U.S. government, which they didn't have before, and that company might get a lot of new contracts go forward. And Fiera Capital, if you don't like mutual funds, you can always buy a mutual fund manager. Fiera is now, I think, the 4th largest asset manager in Canada. They've been buying companies left, right, and center. They bought 2 companies in the U.S. They're raising their dividend, and the stock's done phenomenally well. The leverage, of course, is there. It doesn't take more money to manage, or it doesn't take more people to manage $1 billion than it does to manage $500 million. It's a very high leveraged game in the asset management industry. So we're going to open it up for questions. Hopefully this will work. I might have to switch computers. You can raise your hand from a computer point of view if you want to ask a question. And then we have our one and only advertisement there for our 2 businesses. If you're not a member, we'll give you a special webinar rate of $19.95 for the online version of Canadian MoneySaver with the discount code CC Charlie Charlie on the website. So give us 2 seconds and we'll go through some questions. Oh, just first name's fine. So this is Brian, and I think he's on the line if we're working with Swell. Go ahead, Brian. Hello, Brian. Hello? Can you hear me, Brian? Okay, we'll go to the next one. Sorry about that. Okay, is Brian there? Okay, I got to use my last name apparently. Brian Vincent? Okay, we're going to switch to an email question. Okay, the question is this a good time to purchase REITs? And this is always a tough question for us because we actually think the REIT sector is okay, but only for income. If you are buying a REIT as part of a diversified income portfolio, it's only a small percent, and you only want income, then I think it's okay. I would stick to the larger companies like Chartwell, Dundee, etc. But from a capital gain point of view, we absolutely think the investors are going to continue to avoid this sector. But we're not too worried about the income. We're just worried about the capital gain potential. So 7 or 8% is fairly attractive, but only for part of your portfolio. Do you feel there's a good chance that the market correction is still coming in the U.S. once tapering begins? Okay, so the question is, do you think there will be a market correction once tapering begins in the U.S. specifically? This, of course, is tough because I think there will be a lot of media attention on it, and there will be a lot of short-term panic on the situation. But over history, the market's been very, very good at anticipating events and pricing events into the market. So I think if you were to go away for 6 months, you would almost notice no difference whenever tapering occurs. But I think for that 6-month period, you may get a very volatile, choppy market, and you may get a correction of 5, 6, 7%. But in the long-term scheme of things, if the economy has turned, that will not make a big, big difference to your long-term success. Okay, the question's on Constellation Software, and can it continue to go up higher even though it's gone from $21 to $200? And I'll just take you back to when it was $21, we would get the exact same question on CSU. It had gone from 10 to 20, and people said, well, it's too expensive. Here's a company that's never issued shares in the past, I can't even remember ever. I don't even know if they've ever issued shares. They make very good money. They keep their balance sheet fine, and just one of those rock solid companies. The stock's perhaps done better because everybody loves technology these days, but it's now bigger, and with the technology sector in Canada being quite scarce, Constellation is still one of the preferred names in the space. Absolutely, I think it will go higher. Maybe not another 70%, but it still looks pretty good from a valuation point of view. Okay, so another question I've got is comment on Loblaws and Connexus. Loblaws, of course, missed their earnings the other day, and the stock went down quite a lot. The stock had done very, very well with their various initiatives, so it was kind of poised for trouble if anything went less than perfectly, but I don't think the story's changed. I think it's still a pretty good name. The Shoppers acquisition, I think, will work out well for them. They need to add that division to sort of fight off some of the other threats that are in the space. So I think as a company, it's okay. Short term, wouldn't expect much, but I wouldn't sell the stock because of one quarter. There are another question on Connexus. Connexus is a company that's involved in chemicals in Eastern Canada. Their payout ratio is very, very high, and a lot of people are concerned about it. The stock went down quite a lot over the past week or so ago. We view it as a buy for income. They've got a lot of new projects that will help earnings over the next 6 to 9 months, but it's much riskier than a lot of names out there, so it's not for everybody for sure. Next question is, how do you value Coastal Energy, which has good earnings and takeover potential, but keeps getting hammered? They're very hard. I mean, the oil and gas sector is pretty hard to value. You have to look at it from a cash flow point of view. You have to look at it from an earnings point of view and an asset point of view. The trouble with oil and gas companies is it takes money to make money. You actually don't make any money unless you spend some money and put some holes in the ground and find hydrocarbons. Coastal, we think, is a pretty solid company. They've had a little bit of a disappointing period of time. A lot of investors thought the company was going to be taken over at $24 or $25. That doesn't look to be imminent right now, and so it's a very easy company for people to sell because all these investors wanted a quick takeover, and now they're stuck with a longer term story. So we're not worried about it, but just not expecting a big recovery. But from an asset point of view, management point of view, I know the company pretty well, and I would still endorse it at $15 or wherever it is right now. Okay, we'll move on to another question. Is it still wise to have a laddered bond fund in your portfolio? This is a tough question because, of course, if you're buying an ETF bond fund or a mutual bond fund that's laddered, it can still decline in value in terms of what happens to the individual bonds. From a strategy point of view, we do believe in laddered bond funds and laddered bond strategy, but you have to give it some time here, especially if you're buying an ETF or a bond fund. So we would far prefer an actual bond ladder built yourself. If you have enough assets to buy 5 bonds, I think that's far better because you don't get the whole negative impact of an ETF declining, and you don't actually, there's no reason to sell it. But if you're watching your laddered bond fund go down day after day, you might change your strategy, which we don't think rapid change is a good thing for anyone to do. So we like the category, but we like it more on your own as opposed to holding a bond fund. If you're okay with it and you understand the concept, then it's fine as part of your portfolio. Defensive stocks for the question is defensive stocks for a correction in this economy, and a question on robotics. So it's wondering how to play the robotics space. So from a defensive point of view, Loblaws would be a pretty defensive stock, certainly. Names like Canadian Tire, Cineplex, as mentioned, made money in 07, 08, and 09. Everyone still goes to the movies if you're worried about the economy or the world. We've been talking about Tim Hortons, probably the last company to be in trouble when the economy rolls over. So there's plenty of defensive names out there. We're not really worried about the economy right now, but from a strategy point of view, they're good to add into the portfolio. So there's sort of any safe names. If you've been paying attention, you'll notice that I haven't actually mentioned any utilities or pipelines. They're generally pretty defensive, but because investors have bid up the value of those sectors quite a lot, they're all actually quite expensive. So while we have no issues with their income stream, their dividends, their potential dividend growth, they just might not be as defensive as you want them to be if interest rates actually rose and the economy did well and people wanted to get out of those into something higher growth. So stick with some of the consumer names. Something that you use every day is a pretty good defensive stock. So if you're going to Tim Hortons every day, it's probably a good choice. Is this for, can you go to the next question? I actually don't know the answer to that one. Okay, comment is on Stantec after its recent run-up. So Stantec is an engineering company that's made some good acquisitions, and there's two things we like about Stantec, and we think the future is pretty high for Stantec. First off, actually there's more than two things, but last year they started their dividend. They were profitable for 55 years, and it took them 55 years to decide to start a dividend, and we think that's a fabulous sign for an investment of the future. Since then, they've raised their dividend, and they've also grown their earnings at a much, much higher rate than the rest of the industry. So now you've got a company that's made money forever, raising their dividends, paying a first dividend, beating the industry, making good acquisitions. So I think it's their goal at Stantec is to be one of the top 15 engineering companies in the world, and we really have no doubt that they'll get there over the next 5 years or so. So it would absolutely be one of our favorite companies right now. That doesn't say that. Oh, okay. Retail. So the question is, retail investors have not quite jumped into the market yet. What happens when they do? Well, I love this question because, of course, this is partially happening right now, but not really. So in the U.S., you're starting to see some equity funds get good inflows. You haven't seen that in Canada. Maybe we're still too conservative, or we're still looking in the rearview mirror. But obviously, if you get retail investors en masse selling bond funds and buying equities, you could get a very good stock market for a decent period of time. I don't like to say anything beyond 18 months or so because I really don't know what's going to happen in the world. But as that money flow comes into the market, some of these companies may do better. And so some of the companies that have doubled over the past year might go up another 50% simply on a revaluation of investors. So there's more money coming in, it's more confident money, and they're willing to pay more for earnings. So there's no reason that the market can't do very well for a period of time if the retail investor actually does come back. The question's on bond funds and what's your view on emerging markets? You know, it's a tough one. We're of the view that if the U.S. Is recovering and China is looking better and Europe is not going to roll over and fall off a cliff, then the emerging market economies will do well by default. The problem with some of the bond funds on the emerging markets, of course, is currency. The U.S. dollar has been pretty strong, and that, of course, impacts the other currencies. And so emerging markets not a sector we focus on, but from a diversification point of view, if you wanted 5% of your portfolio in an emerging market fund of some sort, there's not a problem with that. Most Canadian investors don't need more than that because of the currency impact and the currency change and the diversification. But that growth will return. It just hasn't been really exciting over the past few years. And I think you really need North America to get firmly on track before investors get too overly excited about those sectors. Another question is, how is it worth investing in U.S. stocks, or is it better to get an ETF? This is always a tough question for us because there's lots of great companies out there in the U.S., but buying one or two doesn't get you the diversification that you really want to have. So we've been suggesting an ETF with the symbol IWO, which is the Russell 2000 Growth ETF. It's for smaller companies, but the U.S. definition of small companies is it's really quite big. A company in the U.S. That's considered small still might be 2 billion market cap, and in Canada that's almost a large cap. There's not that many of them at that level. So it's not as risky as it sounds, and I think from a growth perspective, it's one of the better ETFs out there, absolutely. And the next question was actually which growth stock ETFs do you like, Canadian, US, and American? So IWO in the US. The Canadian growth ETFs or the choices are not as big as we would like, but there is a small cap ETF, XCX, X-Ray Charlie Sam, and that's sort of the, I don't want to call it the generic small cap index, but because that generic doesn't really sound good, but it's not a bad ETF if you just want some small cap growth exposure. The fees are okay. It's gone up 9% over the past year, so it is slightly ahead of the TSX overall, as it should be with faster growing companies. So another question says, higher rates mean less disposable income, which depresses sales. That is true if you have debt, if you have a mortgage, and you're paying credit card interest, etc. So absolutely, there is an interest rate effect on disposable income. So the key question is, why are rates going up? And so this is where it gets into a whole economic theory, is whether more people have jobs than the impact of higher rates on the other people. And so we really just don't believe that rates are going to go higher significantly or for a longer period of time until there's more jobs in the economy, and we think that will overpower the incremental difference of disposable income. So again, it's also about confidence as well. The interest rates may not go up until there's more confidence, and of course if you're confident, then you're going to spend more money and you're not going to sort of hoard the money under your mattress worried about the banks going out of business, which is what was happening 5 years ago. So absolutely there's an impact. We just think the net impact will still be better. Okay, a new question. We've sort of answered that one already, so we're going to change another one. Oh, okay, this is a bit of a hard question. It says, which companies are positioned with the most cash on their balance sheets? I mean, there's too many companies to go into that in specifics, but there's a big takeover in Canada a couple of weeks ago, Paladin Labs, and they were sitting on $250 million of cash, and so that was quite attractive to Endopharma that wanted to merge with them. So rather than go through sort of the specific companies, because names like Google have hundreds of billions of dollars on their balance sheet, there's all sorts of companies that have excess cash. So the best way, on CDAR, you can pull up the balance sheets of all these companies and see exactly what cash they have. And I apologize for that question, but there's just too many companies that are sitting on lots of cash. It says, the question is, how will insurance companies be affected by weather-related events? This is impossible really to answer because we just do not know what future claims will be. Certainly it's part of the business, and certainly whenever there's an event that causes excess claims, insurance companies' earnings do go down. But from an investment standpoint, this is their business, this is what they've always done, and you just simply can't build it into a model at any in any way, in any manageable way. It's either they're going to happen or they're not, but from a long-term perspective, hopefully the insurance company premium pricing is such that they can handle it. And most have been quite good in terms of handling large-scale events in the past. So the question is tapering, the tapering of how long will it take to get the economy to pay back all the money that has been printed. This is more of an economic theory than a market theory. It will take decades, if not centuries. The question is what happens to the underlying growth of the economy when tapering does occur. So rather than get into a debate of money printing, it's just a question of, can the economy withstand tapering, I guess is the real question, and how long will it take to pay back. And the thing that I like to throw out with people when they talk about the Fed and what they're going to do, the Fed has a unlimited time frame, they have an unlimited amount of money, and they have they can change the rules at any time. So it's not somebody that you would really want to bet against if you were sitting at a poker game. So yes, they are printing money, yes, they are buying back bonds, but they can do this for longer than you and I can stay alive because they can actually change the rules and print money. So what we just think they will withdraw at a slower rate and make sure the economy can handle it. So we might be completely wrong about that, and we also recommend that everybody has a little bit of gold exposure just in case. But it's really, really hard to bet against that and plan a portfolio against that because you just don't know when it will happen and what the ultimate impact will be over a 10, 15, 20, 50-year period. Question is, do you think the banks will split their shares? A lot of them have split at the $100 level in the past, or as they approach $100 levels. And so, yeah, I mean, it's hard to predict which ones, but some of them are long, long overdue to split their shares. So I think what you might see is some of the banks raise their dividends, and then their stocks will, if all goes well, their stocks will appreciate the higher dividends. Some of the names will go closer to certain levels that they're more comfortable splitting. So I wouldn't really predict anything in the next 6 months, but maybe over the next year or so we'll see some bank shares split their stocks. So the question is, can't wait to see dividend hikes for banks. What about any dividend increases for Lifecos, Sun Life, and Great West? Yeah, we think absolutely the life insurance companies are going to raise their dividends in this environment. It's almost a perfect environment for them in terms of growing their business. From an asset point of view, all their assets have gone up in value. Their assumptions are better. Their actuaries are much happier in terms of predicting what's going to happen with their liabilities and their assets. So yeah, there's certainly room there on the banks as well as the life insurance companies. Even maybe Manulife might actually raise their dividend one of these days, but don't hold your breath on that. But it probably will be possible over the next 6 months. Okay, we just did that one. Yep. What is my outlook for commodities next few years, such as steel, now that Chinese growth is much lower? I would say it's neutral to positive. It's again, it's not something we really focus on because lots can change. If the U.S. does recover, that takes a bit of the pressure off. If the rest of the world can do better than expected, that takes some of the pressure off. But from a commodity point of view, I think we're kind of going to just bide time, tread water for a period of time. I think there's enough positives in the world that we're not going to collapse on commodities, but there's enough negatives in the world that we're not going to rise up and have a 2008 sort of super spike scenario. So again, if your commodity exposure is in line and not unreasonable, it's not something you really need to be concerned about. But certainly from I just don't believe we're going into a super commodity cycle like some people talk about. What do you think of REITs going forward, as there's lots of high quality companies that have been beaten up? So I think REITs are fine for income. We talked about this earlier. Most are okay. There was a company, Partners REIT, cut their distribution by 22% this week. Sometimes REITs use that as an excuse to cut if they're thinking of cutting or if they don't have enough cash flow to maintain distribution. Once one or two companies have done it, you may see some more. But in general, we're not too concerned about the income flow from REITs. We're just concerned about nobody caring about them, and they just might flatline. So if you have a market that's recovering, and the Canadian market in particular is doing better, REITs just aren't that exciting to us. But for income, we're not worried about them as a sector. Well, this is a good question. It says, what is a reasonable yield to chase? And so the problem with the question is it's using chase and reasonable in the same sentence. So I think if you've got a yield above 6% in this environment, there's a reason for it. Either higher debt, more risk, more cyclicality of your business. Something's causing that yield to be higher than what it should be on a normal scenario. Not necessarily a bad thing, but as we mentioned at the start of the webinar, it's far better for your financial future to buy a company that can raise their dividend. So maybe the problem with a 6% dividend is that it's not going to be raised very often. And so you're going to get your 6%, you'll be fine, but you'll be very envious of the company next door that raises their dividend and their stock price doubles. So 6 is probably, once you're at 6, I think your risk is increased. I'd bump that up to 7 for the REITs because of their corporate structure. They spin out more money as dividends or as distributions. So. Would you have in mind a very good growth company providing capital gains and no dividends? The best one we could possibly tell you of is Avigilon. It's the one that was on the chart earlier. They make cameras, high definition equipment for security. Of course, the world needs more surveillance equipment. We spent a lot of time on this company when we started following it at 5i Research because we wanted to make sure that it actually was going to continue to grow. And what we found over the past 6 months is that their growth rate has actually accelerated. And we think in a few years the company will just get sold to a larger entity. Their products, their systems work well. It's just a better product in our mind, and the stock's done very, very well. And now it's over $1 billion market cap, and more people are paying attention as it becomes more available to a wider group of investors. Next question is, what do you think of trailing stop loss orders? We don't like stop loss orders really at all. We don't mind investors using a mental stop in their head, but to actually put it in a system where bizarre trading, flash crashes, and various entities can trigger that stop loss right away, we're not real big fans of it. Trailing loss, stop loss, if you keep moving it up as the market goes up, that's okay. If it's a large liquid stock that you've made lots of money on, it's not that big of a problem, but in general, we just say use a lot of caution on stop loss orders. Okay, I got to skip that one because I'd have to do too much computer work on that one. Oh, the question is this the new normal? Most, if not all, banks are not marked to market. This, of course, there's referring to a lot of the changes that happened post the financial crisis in terms of bank adequacy. ratios and changes to the rules and things like that. So I think the market has adjusted to the new rules. I think banks have adjusted to the new rules. I don't want to say it's the new normal because banks are still highly levered, and a situation where all asset prices go down dramatically like they did in '08 would still be very bad for the banks. But investors have adjusted to that, and the floor has been raised because you have house prices that have recovered, asset prices have recovered, loan losses have recovered. You're just at a higher level from a safety point of view than you were in '08. But I don't want to understate the risk. If everything went down again like it did in '08, a lot of the banks would still be in trouble despite some of the new rules and capital ratios. Which investment products would you recommend for investors to purchase to have gold, silver exposure? This is a little bit harder to do because we actually think the upside on gold equities is much more than gold bullion right now. The equities have just been absolutely decimated. We still believe in the senior producers. The juniors a lot of them are in big trouble. There's a company called Colossus this week went down 50% because it doesn't look like they're going to make it. So we would stick to an ETF, and we would stick with the XGD, X-Ray George David in Toronto, for a gold producer ETF. Hasn't done much recently, of course, with the decline, but it holds all the senior companies, none of the juniors, and from a diversification standpoint, it's about as good as you can get, at least in the Canadian market. You can own gold bullion. There's a couple of funds out there. My old company Sprott has a bullion trust that's got fairly low fees. If you just want to hold gold as an insurance form, that's fine too. There's about 6 or 7 vehicles out there that you can do it. There's a Swiss ETF that holds their gold in Switzerland if you're worried about the North American government. But either hold gold equities in a diversified ETF, or just hold gold itself in one of these products that are out there in the market as a protection. This is a good question. It says if bond interest rates are down, should I still get some bonds in my portfolio? And then it asks for specific bonds, which we're not going to go into specific bond recommendations here. But as far as bonds go, again, there's nothing wrong with owning a bond. A lot of people say, oh, I want to sell all my bonds because they're going down. But if you've got an asset allocation strategy for your future retirement, which consists of owning 10 or 15% bonds, then you absolutely can maintain that and just collect the income. Don't worry about the ups and downs in the market and interest rates. Just you're there for income, you're there for safety, and that part of your portfolio will be very beneficial to you when the market decides that it wants to go down quite a lot over a period of time. So we don't want to beat up bonds too much. We just think that a lot of investors have had too much in bonds. They've had 50-60% in bonds and REITs and utilities, and 50% of anything is too much in our view. Next question says, a couple of stocks that have had great returns, Pembina Pipeline, AltaGas, should I still hold them? Any comments on these two? Well, specifically, these two companies are two of the absolute gems in the sector, we think. The track record of both increasing their dividends has been very impressive. They've both done some very good acquisitions. Both stocks are relatively expensive, but it's one of those situations where each stock has a good reason to be expensive. So we'd much rather own a name like Pembina or AltaGas that can grow by buying a company and can grow its dividend than some of the larger multi-billion-dollar companies that sort of just go along and plod along slow and steadily. Okay, so I'm going to maybe shift it. We'll wrap it up in 1 or 2 more questions. Lana's told me that I need to mention that 5i Research is available for membership still. We're probably going to cap that membership over sometime in 2014 because we're getting a little bit too busy. The next question is on DHX Media. DHX Media, I'll just pull up the numbers here for you, is a company that's involved in children's entertainment, so it's a television programming company. The stock's up 138% over the past year, but here's the good stuff. I mean, that's good too, but if you're looking at buying it right now. Management has done it all before. They have excellent experience in the industry. They're fully committed to this company. They've done some fabulous acquisitions already. They bought a company called Cookie Jar and a couple of other companies. They started paying their first dividend not that long ago. A few months ago, or a few weeks ago actually, they increased their dividend by 50%. And they've done some good financings to put this all together. So it's a company with a good growing dividend. Well, the dividend's only 1%, but a new growing dividend, great management, 400 million market cap. Earnings are, according to Bloomberg, expected to more than triple over the next year. And for all those good things, you pay 27 times earnings. And a lot of people would say 27 times earnings, that's ridiculous. But if earnings are going to triple and they're going to continue that growth trajectory, then 27 times earnings for a fabulous company with good management, we have absolutely no problem with that company, and we hope to follow it sometime in 2014. A question on Europe. It says, what are your thoughts on European markets going into 2004? Not an expert in Europe at all. I was in Europe a month ago. Looked okay to me from a common sense Peter Lynch point of view. I couldn't tell that there was any problem in the tourist areas anyway. I think it'll chug along. I think the fear of the euro breakdown and breakup is dissipating, so I think that'll be good for valuations. And I think, again, if the North American economy decides to actually do something, Europe will get carried along for the ride. So from a stock point of view, stock market point of view, you've got London up 13%, Paris up 18%, and Germany up 20% this year. So investors are anticipating a recovery, just like they are in the U.S. with the S&P 500 up 26%. So they're buying into the recovery, but it's not assured recovery yet. So I think if they do get a recovery, the market will do okay. And economically, I think it's much the same as the U.S. Doing better, but not great. But as long as it's doing better on a consistent basis, then we should be okay. So I'll do a couple more. It says, would you comment on country diversification and whether you would currency hedge? For most investors, we think 10% international diversification is about appropriate. A lot of people like to buy into the U.S. because they're familiar with some of those companies. You can buy more in the U.S., but I'm talking outside of North America. You don't really need more than 10%. There's currency issues, there's regulatory issues, there's volatility issues. But on currency diversification, we're firmly of the belief that if you're going to diversify your assets, you should diversify your currency as well. Canadians got really quite complacent over the past 10 years because the Canadian dollar was so strong. But this year the US dollar picked up steam, and suddenly the Canadian situation didn't look like a slam dunk again. So we don't mind currency diversification if you're going to diversify your assets. So it does benefit the overall situation of the portfolio. You just can't worry about it on a short-term basis because the international names, of course, can be very, very volatile. Okay, so we're going to wrap up. We have a lot of questions left over, but if you send the questions to info@5iresearch.ca, so info at 5i, the number 5, the letter I, research, research.ca, we will do our best to answer those questions. I actually don't know how many are still left, so give us some time on that, but we will try and answer everyone that comes in. So thank you for joining us. Sorry about our technical difficulties on our first one, and it's our first one, and we'll do better on the next one, and we'll let you know when that is when we decide. Thank you.